Quote of the day.
Your best investment is yourself. There is nothing that compares to it. Warren Buffett.
Greetings to you fellow investors and aspiring traders. Today, we're diving deep into a topic that can make or break your investment decisions, and it's about financial ratios. Buckle up, because by the end of this video, you'll surely understand why these ratios are the secret sauce to informed investing. Picture this now, you're a captain steering a ship through choppy waters. Financial ratios are your navigational instruments, guiding you through the sea of numbers to make sound investment choices. These ratios offer a glimpse into the company's financial health, helping you assess its performance, stability, and potential for growth. We will be discussing four main types of financial ratios: liquidity, profitability, debt or solvency, and market ratios. Now, let's unravel the mystery behind liquidity ratios, the first tool in our investor's toolkit. Think of these ratios as your company's quick cash measurement, how easily it can meet its short-term obligations. We use values from the company's balance sheet to calculate those ratios. First up, we have the current ratio. This metric, it's like checking if your company has enough liquid assets to cover its short-term debts. You simply divide its current assets by its current liabilities. A ratio greater than 1 indicates a healthier financial position, as it shows your company can meet its obligations without breaking a sweat. It is like having a well-stocked pantry to weather any storm or difficulties. Next, meet the quick ratio, also known as the acid test ratio. This one is all about speed. It assesses your company's ability to pay off debts without relying on slow-to-sell assets like inventory. By excluding inventory from the equation, you get a clearer picture of real liquidity. A higher quick ratio means your company is quick on its feet, ready to handle financial challenges with confidence. This ratio focuses on cold hard cash. It's as straightforward and conservative as it gets. Divide your company's cash and cash equivalents by its current liabilities. A higher cash ratio indicates your company has more liquid cash on hand to tackle its debts, ensuring stability and financial strength. And there you have it, the captivating world of liquidity ratios, designed to help you assess a company's financial flexibility and ability to meet short-term obligations. Now armed with these insights, you're equipped to make well-informed investment decisions that could potentially steer your portfolio towards smoother waters. Now, we will be delving into the heart of profitability. It's time to unlock the power of profitability ratios. Get ready to discover how these ratios demonstrate the company's ability to turn a profit and generate sustainable, steady returns. Let's kick this second category off with the gross profit margin. Imagine you're running a factory. This ratio reveals the efficiency of your production process. It's calculated by subtracting the cost of goods sold from total revenue and dividing it by revenue. Calculation done, you get a percentage that showcases how effectively your company turns raw materials into profit. A higher gross profit margin? Well, that's like squeezing every last drop of juice from the fruit. That would simply mean more profit for your effort. Next up, we have the net profit margin, a real measure of your company's financial solidity and prowess. This ratio takes into account all expenses, including taxes and interest. By dividing net profit by total revenue, you'll disclose the true bottom line impact of your company's operations. A higher net profit margin signals efficient management and control over costs. It's like optimizing your financial engine for maximum efficiency. Now, let's venture into the realm of return on equity, or ROE, the heavyweight of profitability ratios. Think of your company as a skyscraper, and each floor represents an equity investment. ROE measures how well your company generates returns for its shareholders' investments. By dividing net income by shareholders' equity, you'll unveil the multiplier effect. A higher ROE indicates efficient allocation of resources, turning each investment flaw into a financial trampoline that propels your profits high to the sky. There you have it, the illuminating world of profitability ratios. These metrics will give you a glimpse into your company's profit generation prowess, efficiency, and its ability to reward its investors. With these valuable insights at your disposal, you'll have the power to thoroughly evaluate a company's financial potential and confidently make well-informed investment decisions. Time to explore the bedrock of financial stability, solvency ratios. These metrics are like the pillars holding up your financial fortress. They will be revealing your company's ability to weather storms and meet long-term obligations. Let's dive in. First up, we have the debt-to-equity ratio, your company's debt level compared to shareholders' equity. It's like estimating the weight your fortress can bear. Divide total debt by shareholders' equity, and you'll reveal the proportion of external funds versus internal funds. A lower ratio implies less reliance on debt, indicating a sturdy financial foundation. It's like ensuring your fortress walls are made of solid stone. Next on our solvency journey is the debt-to-assets ratio. Divide total debt by total assets, and you'll get the percentage of assets funded by external sources. A lower ratio here means your financial structure is more stable, like a skyscraper built on solid bedrock. Last but certainly not least, let's discuss the interest coverage ratio, your company's capability to handle interest payments on its debt. It's like ensuring your financial machinery runs smoothly. By dividing earnings before interest and taxes, EBIT, by interest expenses, you'll get the number of times your company can cover its interest payments. A higher ratio shows that your company can comfortably meet these obligations, like well-oiled gears in a well-functioning machine. Here we are, done with the enlightening world of solvency ratios. These measures offer insights into your company's long-term financial strength, its ability to meet debt obligations, and the solidity of its financial structure. Armed with these insights, you'll be better prepared to assess a company's ability to weather financial storms and make prudent investment choices. We've journeyed through the financial landscape, explored the depths of ratios, and now, we're reaching the pinnacle, the market ratios. Buckle up because what you're about to discover can truly elevate your investing game to new heights. Imagine your investments as rockets ready to launch. Market ratios are your launchpad, propelling you towards informed decisions and potentially stratospheric returns. Let's dive into the final frontier of ratios. First on our market journey is the price-to-earnings ratio, the talk of the town in investing circles. It's like peeking into the audience's demand for a blockbuster movie ticket. Divide the stock price by earnings per share, and you'll see how much investors are willing to pay for each dollar of earnings. A higher PE may indicate high growth expectations, while a lower PE could signal value. It's like assessing the buzz around your investment, blockbuster. Next, meet the price-to-sales ratio, your window into a company's sales performance. A lower ratio might hint at potential value, while a higher ratio could reflect growth prospects. It's like sizing up the prime location of your investment storefront. For our last financial ratio, let's explore the dividend yield ratio, a potential reward for your investment. Have you ever thought of calculating the interest rate your investment pays you? You can easily do that by dividing the annual dividends per share by the stock price, revealing the percentage return on your investment through dividends. It's a great way to measure the profitability of your investment. A higher dividend yield could mean steady income, while a lower yield might signal growth-oriented stocks. It's like reaping the fruits of your investment harvest. And there you have it, the exhilarating world of market ratios. These ratios give you a glimpse into investor sentiment, the value investors place on a company's earnings and sales, and the potential rewards in the form of dividends. Armed with this knowledge, you're poised to embark on a thrilling investing journey that's grounded in solid financial understanding. Remember, fellow financial explorers, what you've learned today isn't just information, it's a foundation for your future investing endeavors. By harnessing the power of these ratios, you'll confidently navigate the complexities of the market, make informed choices, and potentially turn your investments into true success stories. And that's a wrap on financial ratios. I hope you found this video informative and helpful in your journey towards successful investing or any purpose you are after. If you have any questions related to finance and investing, feel free to leave them in the comments below. And if you enjoyed the content and want to see more, don't forget to like and subscribe to our channel. Thank you for watching, keep that learning spirit alive, and happy investing.